What is up, crypto crew? Get ready for a rapid-fire update that's going to blow your mind. The market is moving at lightning speed, and you need to be in the know. Today, we're diving deep into the signals that could change everything. We're talking about those rare Bitcoin buy signals and how the massive influx of stablecoins is playing a crucial role in all of it. Are we on the verge of another major surge? We break down the indicators, the history, and what it all means for your portfolio. Next up, we've got a massive corporate play that's turning heads. A major agri-commodity giant is making bold moves, strategically integrating Bitcoin into its treasury. We're exploring the meticulous planning, the institutional-grade security measures, and why this company believes in Bitcoin's long-term potential. This isn't just about holding an asset, it's about a fundamental shift in how established businesses are thinking about their financial future. Then, we're asking the burning question: has Bitcoin finally broken free from its seasonal slump? For years, September has been a tough month, but the data is showing something different this year. We're looking at the macroeconomic winds, the impact of institutional flows, and whether this could signal a new, more mature cycle for Bitcoin. Is Red September a thing of the past, replaced by a new era of consistent growth? And finally, we're putting the spotlight on a major rival, Ethereum. Analysts are pointing to key advantages that are allowing ETH to potentially outshine even Bitcoin in certain areas. We're diving into ETF inflows, the impact of staking, and why big companies are increasingly turning to Ether. What does this mean for the broader market hierarchy? Make sure you're subscribed and the notification bell is on so you don't miss a single update. Let's get into it. Uncommon signals, stablecoins fueling Bitcoin's next surge. For years, the crypto market has been captivated by the elusive Bitcoin buy signal, those rare moments that hint at significant price appreciation. Now, with the increasing prominence of stablecoins, a new dynamic is emerging, potentially amplifying these signals and offering a unique lens through which to view investment opportunities. This deep dive explores the intricate relationship between stablecoin inflows and Bitcoin's price action, examining the historical context of these rare signals and their implications for investors navigating the volatile digital asset landscape. The concept of a Bitcoin buy signal often hinges on specific market metrics, with the Binance Bitcoin stablecoin ratio emerging as a particularly intriguing indicator. Traditionally, when this ratio approaches 1, it signifies a market equilibrium where the volume of Bitcoin and stablecoins on the exchange are nearly equal. This parity suggests a substantial influx of stablecoins that have not yet been converted into Bitcoin, potentially indicating a large pool of capital poised for accumulation. Historically, this specific signal has only appeared twice before, both during bear markets, and each instance was followed by substantial price rallies. For example, a similar signal in March preceded a significant surge, propelling Bitcoin from $78,000 to an all-time high of $123,000. While past performance is never a guarantee of future results, the rarity and historical accuracy of this particular indicator command attention. Stablecoins themselves are foundational to the crypto ecosystem, providing much-needed liquidity and a stable medium of exchange amidst the inherent volatility of cryptocurrencies. They act as a shield for traders looking to preserve capital during sharp market downturns, and their utility is expanding beyond mere trading. The growing trend of crypto payroll, where companies are increasingly using stablecoins for salary disbursements, highlights their practical application, particularly in regions facing economic instability, such as Argentina. This adoption streamlines transactions and mitigates the risk of employees receiving volatile crypto payments, offering a more predictable income stream. The rise of crypto-native business tools and the increasing acceptance of stablecoins in business-to-business transactions further underscore their growing integration into the financial mainstream. However, relying solely on historical buy signals carries inherent risks. The cryptocurrency market is notoriously dynamic, influenced by a confluence of factors including regulatory shifts, technological advancements, and evolving market sentiment. These external forces can significantly alter price behavior, potentially rendering historical trends less reliable. Key risks include the potential for abrupt price movements that can skew technical indicators, the danger of overemphasizing technical analysis without considering fundamental and sentiment factors, and the specific vulnerability of stablecoins to regulatory actions and macroeconomic conditions, which can create price behaviors not captured by past signals. Regulatory frameworks, particularly in Europe with the markets in crypto assets, MiCA regulation, are shaping how businesses, especially small and medium-sized enterprises, SMEs, can leverage stablecoins for payroll. MiCA imposes stringent compliance and operational requirements, including the need for regulatory approval, adherence to transparent reporting standards for reserves, and robust consumer protection measures to educate employees on the risks and benefits of stablecoin payments. Despite these compliance challenges, the inherent benefits of stablecoins for payroll, such as cost-effectiveness and transaction speed, continue to make them an attractive option for businesses seeking efficiency and a competitive edge. As the crypto market continues its rapid evolution, understanding the interplay between Bitcoin buy signals and the expanding role of stablecoins is paramount. These signals, when viewed within the broader context of market dynamics and regulatory changes, can offer valuable insights for investment strategies. By integrating stablecoin strategies and staying attuned to these evolving indicators, investors can better navigate the complexities of the crypto terrain and position themselves for success in this ever-changing financial frontier. But is this the only major shift happening? Get ready, because next we're diving into how a major agri-commodity player is making a huge statement by bringing Bitcoin right into its corporate treasury strategy. Corporate crypto, Sadot Group bets on Bitcoin treasury strategy. In a significant move signaling the increasing acceptance of digital assets within traditional finance, Sadot Group Inc., a global leader in the agri-commodity supply chain, has partnered with Bitcoin Bancorp Inc. to strategically develop a cryptocurrency treasury strategy. This collaboration aims to optimize capital allocation, enhance liquidity management, and ultimately boost long-term shareholder value by exploring a measured diversification of its cash reserves into Bitcoin. The initiative underscores a growing trend among established companies to view Bitcoin not just as a speculative asset, but as a potential store of value and a hedge against inflation, integrated through robust, institutional-grade frameworks. The core of this partnership involves establishing a comprehensive treasury strategy that aligns with current accounting standards and regulatory expectations. Bitcoin Bancorp will assist Sadot Group in creating a board-approved policy framework that adheres to the Financial Accounting Standards Board, FASB, ASU 2020-308, which provides clearer guidance on the fair value accounting for crypto assets. This includes implementing stringent governance structures, defining risk limits, and establishing detailed disclosure schedules to ensure transparency for investors. Furthermore, the partnership will focus on selecting an institutional-grade custodian to safeguard the digital assets. This involves setting up operating procedures that incorporate multi-signature wallets, cold storage solutions, service organization control, SOC 2 compliance, and adequate insurance coverage, all of which are critical for institutional adoption and risk mitigation. Sadot's CEO, Chage Ravid, articulated the company's rationale, emphasizing Bitcoin's unique characteristics, its fixed supply and its burgeoning institutional adoption. These factors, he noted, make it a compelling asset for corporate treasuries seeking diversification and a hedge against traditional financial system risks. The company's approach is deliberate and phased, prioritizing the establishment of robust policy and risk controls before any actual Bitcoin purchases are made. This methodical strategy ensures that any integration of Bitcoin aligns with Sadot's overall risk management framework and its core mission of operating within the global agri-trading sector. Eric Novshin from Bitcoin Bancorp echoed this sentiment, stressing that the initial focus is on building a sound allocation framework and selecting custodians that meet the rigorous standards expected of publicly traded companies, while crucially maintaining operational liquidity. This strategic initiative is particularly timely, coinciding with recent regulatory clarity provided by FASB ASU 2020-308. This update offers a more transparent accounting treatment for crypto assets, making it easier for public companies to incorporate digital assets like Bitcoin into their treasury functions. Sadot views Bitcoin as a potential long-duration, scarcity-based reserve asset that can complement its existing financial strategy without diverting attention from its primary business of delivering essential food and feed products globally. The company has explicitly stated its commitment to its core operations, assuring stakeholders that this treasury initiative will run parallel to its agri-commodity activities, with no impact on its delivery commitments or operational focus. Looking ahead, the next steps for Sadot Group involve finalizing policy documentation, selecting a custodian, and implementing operational procedures in close collaboration with Bitcoin Bancorp. Any potential Bitcoin acquisitions will be subject to board approval and will be disclosed in accordance with SEC and NASDAQ regulations. The company has made it clear that it has no intention of engaging in token issuance, staking, lending, or derivative speculation, underscoring its commitment to asset preservation and transparency. While the company acknowledges the inherent risks associated with digital assets, including price volatility and regulatory uncertainties, this strategic partnership marks a significant step in its exploration of integrating Bitcoin into its long-term financial planning. It's a bold move, but is it a sign of a broader market shift? We're about to find out as we explore whether Bitcoin itself is breaking its infamous seasonal slump and entering a new, more bullish cycle. Bitcoin's calendar makeover. Is Red September finally over? For years, the month of September has carried a notorious reputation in the cryptocurrency world, often dubbed Red September, due to its historical tendency to see Bitcoin prices decline. This pattern, observed consistently between 2017 and 2022, saw Bitcoin consistently close the month in negative territory, creating a deeply ingrained perception of September as an unfavorable period for the digital asset. However, recent trends suggest that this long-standing curse might finally be breaking, with Bitcoin showing signs of resilience and even growth during this historically challenging month, potentially signaling a maturation of the market and a departure from its calendar-bound vulnerabilities. The historical underperformance of Bitcoin in September can be attributed to a confluence of factors, including geopolitical tensions, regulatory uncertainties, and broader financial market volatility that often intensified towards the end of the third quarter. These cumulative shocks, coupled with a general aversion to riskier assets during this time of year, cemented September's negative legacy. This pattern is not unique to Bitcoin. Traditional markets, such as the S&P 500, have also historically shown weaker performances during September, according to various financial analyses. However, this narrative began to shift in 2023. A pivotal moment arrived when a federal appeals court ruled against the SEC's rejection of Grayscale's bid to convert its Bitcoin trust into a spot ETF, deeming the decision arbitrary and capricious. This landmark ruling revived anticipation for a spot Bitcoin ETF approval, a sentiment that proved prescient as such approvals materialized in early 2024. This legal victory, as noted by industry experts, forced regulators to reevaluate their stance, creating a more favorable environment for digital assets. Following this, in September 2023, Bitcoin recorded a notable monthly gain of approximately 4%, a significant departure from its previous trend. Further bolstering this positive momentum, macroeconomic factors played a crucial role. The Federal Reserve's decision on September 18, 2024, to implement its first rate cut since March 2020 was widely welcomed by markets, signaling a more accommodative monetary policy. Simultaneously, the launch of World Liberty Financial's initiatives contributed to a narrative of returning favor for cryptocurrencies. This combination of bullish signals fueled optimism for an upcoming October, referencing October's historically favorable performance for Bitcoin, which has seen 6 consecutive years of gains. As September 2024 dawns, the positive trend appears poised to continue. Spot Bitcoin ETFs are consistently recording billions of dollars in daily trading volumes, indicating robust institutional demand. Furthermore, Federal Reserve Chair Jerome Powell's recent remarks at Jackson Hole adopted a decidedly dovish tone, suggesting a potential adjustment in monetary policy in response to evolving economic conditions. Powell indicated that rebalancing of risks could justify an adjustment of our monetary policy, hinting at possible rate adjustments following upcoming FOMC meetings. Adding to the positive outlook are reports from China regarding the potential authorization of stablecoins pegged to the offshore yuan, which could act as another catalyst for market growth. The anticipation of a further rate cut in the near future could serve as a significant catalyst, potentially solidifying Bitcoin's departure from its red September past and ushering in a new era of consistent positive performance within the crypto calendar. While these favorable signals suggest a potential structural evolution in the market, it remains to be seen whether this trend reflects a sustainable shift or a temporary boost driven by macroeconomic policies. The crypto community is watching closely to see if Bitcoin has truly redefined its seasonal cycle, moving beyond calendar-based performance to a more mature and stable growth trajectory. But it's not just Bitcoin that's making waves. We're now turning our attention to Ethereum, as analysts reveal surprising advantages it holds over Bitcoin in today's market. Ethereum's ascent, analysts pinpoint key advantages over Bitcoin. In the dynamic world of cryptocurrencies, Ethereum, ETH, is increasingly demonstrating its strength, with analysts highlighting several key factors that position it favorably against Bitcoin, BTC, in terms of growth rates and market appeal. While Bitcoin remains the undisputed leader by market capitalization, Ethereum's unique technological underpinnings, coupled with evolving market dynamics, are enabling it to outpace its larger counterpart in specific growth metrics. This analysis delves into the reasons behind Ethereum's current outperformance, focusing on institutional inflows, supply dynamics driven by staking, and corporate adoption trends. One of the most significant drivers of Ethereum's recent success is the robust demand for spot Ethereum ETFs. In August, ETH-based exchange-traded funds attracted an impressive $3.8 billion in inflows. This starkly contrasts with Bitcoin-focused instruments, which experienced outflows totaling $751 million during the same period. This divergence in ETF performance suggests a strong investor appetite for Ethereum, potentially driven by its broader utility and upcoming technological developments. The success of these ETFs indicates a growing institutional comfort level with Ethereum as an investment vehicle. Furthermore, Ethereum's supply dynamics are significantly influenced by the growing popularity of staking. The number of staked ETH tokens has surpassed 35.7 million, representing a substantial $162 billion, which accounts for approximately 31% of the total cryptocurrency supply. Staking, a process where holders lock up their ETH to support the network and earn rewards, effectively reduces the circulating supply of Ether. This reduction in available supply, combined with consistent demand, can create upward pressure on prices. The growing participation in staking reflects a long-term commitment from holders and a belief in Ethereum's future value proposition. Demand from corporate treasuries also plays a crucial role in Ethereum's advantage. Analysts note that public companies are increasingly acquiring Ethereum, viewing it as a strategic asset. Min Young, an analyst at Presto Research, confirmed that this buying pressure is supported by such corporate activity. While acknowledging the strong performance, Young also expressed caution regarding the sustainability of this trend and the ability of firms to maintain such elevated purchase volumes over the long term. The debate around digital asset trusts, DATs, and their role in enhancing ecosystem visibility versus potential conflicts of interest continues, but the trend of corporate acquisition is undeniable. Currently, the four largest public company holders of Ethereum, Bitmain, SharpLink Gaming, BitDigital, and BTCS, collectively hold approximately 2.7 million ETH, valued at around $12 billion. This significant corporate holding demonstrates a tangible commitment to Ethereum as a treasury asset. However, not all experts are bullish on the long-term implications of corporate staking. Joseph Shalom, co-founder of SharpLink, recently warned of the risks associated with companies pursuing yield through holding Ethereum, highlighting the potential for significant downsides if not managed carefully. Despite these cautionary notes, the overall trend indicates that Ethereum is carving out a distinct and compelling position in the market, separate from Bitcoin. JP Morgan analysts, in a separate report, also identified 4 key factors contributing to Ethereum's edge over Bitcoin. While the exact details of JP Morgan's analysis were not provided in this report, their acknowledgement of Ethereum's advantages further validates the narrative of ETH's growing prominence. The increasing institutional adoption, coupled with the deflationary pressures from staking and the robust performance of ETH ETFs, paints a picture of a network that is not only technologically advanced, but also increasingly attractive as a financial asset for both retail and institutional investors. So, Ethereum is making some serious power moves. But before we sign off, let's quickly recap the biggest stories of the day and make sure you're subscribed. And that's a wrap for today's massive crypto update. We saw rare Bitcoin buy signals potentially amplified by stablecoins, a major agri-company integrating Bitcoin into its treasury. Bitcoin showing signs of breaking its red September curse, and Ethereum demonstrating clear advantages over Bitcoin. Don't miss out on any of these crucial developments. Hit that like button, subscribe to Bitcoin Bulletin, ring that notification bell, and follow us on all social platforms so you're always in the know. We'll see you in the next one.